If Social Security is your only income, you pay no taxes. Isn't that right, big baby? Isn't that right? Let me show you. We're going to use this diving into Right Capital software. All right, so you see, we got Kate and Keith Sample. They got no net worth at all. Nothing. They got no net worth. All right, now how old are old Kate and Keith? They're both 67 years old. All right, their income is going to consist of all of Social Security. Katie's going to get $3,200 at her full retirement age of 67. Actually, her full retirement age, because she was born before 1960, is a little bit earlier than that, but it doesn't matter. Keith is going to get $3,200 as well. So $3,200 times 2 is $6,400 a year times 2, $6,400 a month times 12. They're going to make $76,000 a year in income. 76,000 bucks. How much taxes are they going to pay? Not going to pay anything. All right, let me show you why. Social Security works. You got, in terms of figuring your taxation, you got to take your total Social Security benefit, which is $76,800. You divide that by 2. All right, so we're going to do this divide by 2, which gives us $38,400. All right, so now we're married filing jointly. We take the first $32,000. We'll go 0 to 32. None of that is subject to any income tax. All right, 32 to 44. 50% of that amount is subject to income tax, and anything above 44, 85% is. All right, I should say 0.85. All right, so in this case, we got 32,000, 0. We got 12,000. No, we only have, because you take half, you got 6,400. 6,400. And we times that equals this times that. So in this case, only $3,200 of our $76,000 of Social Security is subject to taxation. But our standard deduction is what? We'll just say $26,000. It's more than that, but I'm just using that for example. Deduction. All right, so that means we have no taxable income. I'll show you a little bit different on a 1040 here in just a second. But remember, you take your total Social Security income, divide by 2, the first $32,000 if you're married filing jointly, none of that is taxable or subject to taxation. You can, I guess, the semantics in some regard. The next $12,000, which is $6,000, a half of that is subject to taxation. But because we only have, in this case, $6,400, the first $32,000 is tax-free. The next amount of money is $6,400. Only $6,400 of that is subject to taxation, but only half of that. So we have $3,200 as our taxable Social Security. We have a standard deduction of $26,000. That means no taxable Social Security. So let's go back to Right Capital, and I'm going to show you. So we go to income. We're going to say in this case that's our only income. We have no investments. We just have Social Security. And we're going to say our goals, just for giggles, is $76,000 a year, just for simplicity. But anyway, we're going to go to tax. All right, we'll check this out, my friends. We're going to show you 1040. Go to the first full 1040. We get 81,000 of Social Security benefit next year. Only 4,400 of that is subject to taxation. Our standard deduction is $28,000. There is no taxes due whatsoever. None. Because our standard deduction dwarfs whatever our taxable Social Security is. And if you go to the cash flows, I'm going to show you, it's crazy. I'm telling you, man, people make this mistake all the time. First full year of 2022, $81,789 is our Social Security. Our goals are $78,000. There's a reason I did that. So we have net flows of $3,500. No taxes at all. And by the way, you want to hear something? Want to see something funny? You know what state we live in? We live in California. But California is horrible for taxes. I mean, it's horrible for a lot of things, but income tax for most of us is not it. We can put you in Maryland. Maryland is horrible for taxes. Maryland is horrible in a lot of things, but income tax is not it for most of us. No taxes. We'll put you in Massachusetts. Massachusetts is horrible for taxes. Massachusetts is horrible for a lot of things. Income tax isn't one for most of us. Let's put you in Massachusetts. All right. Taxes. No taxes. Let's put you in Nebraska. Put you in Nebraska. We'll put you in Nebraska here. Nebraska, I'm not sure. Vinny, stop. Nebraska. Taxes. Nothing. Now here they get a little bit of taxes. 0.2%. Wow. In Nebraska. No other state does. All right, so anyway, we go back to retirement. This is what's interesting, though. We have a 0% probability of success, which always cracks me up. This is why some of these Monte Carlos I just chuckle a little bit about. We're going to run out of money. Oh my goodness, we have a 0% probability of success. And yet our median liquid assets we're leaving are $67,000 in today's dollars, but yet we have a 0% probability of success. Does that make any sense at all? Let's say confidence. How could this be? There's our confidence, it goes up. I mean, this doesn't make any sense. It's just the reason why we have a 0% probability of success is because we had no liquid assets to start with. And so the software's like, I don't know what to do. I don't know what to do because we have we have no net worth, which means we started with no net worth. We have 0% probability of success. But if you go down to our goals, we have total inflows of $137,000. Our total outflows are $131,000. Does that make sense? So the software's like, I don't know what to do. What do we do? What do we do? We don't have any money. There's no liquid assets. So I don't know what to do. It just always cracks me up because it says a 0% probability of success. But if our goals are 122 to spend and our income is 128 to spend and our income's guaranteed and we only pay a little bit to the state of Nebraska taxes, we have positive cash flows. We're not running out of money. But because we're not running out of money, because we're not saving it, essentially we're spending it. I have us set up to spend every single penny that we have. We have a 0% probability of success, even though we have at our desk $67,000. It cracks me up. So just be careful on the software when it says 0% probability of success, because again, if you have big pensions and Social Security, it might be misleading, if that makes sense. Now, look, I still use it, but I use it in the caveat. It says, all right, well, the bulk of our income is Social Security. Yeah, you might only have a 75% probability of success, but are you running out of money? No, you know when we're not running out of money because we have our income is less, or here's our Social Security, 134 in, what's that, 22 years. 134 is our income, and our goals are 128. So we haven't run out of money. It's just the software says you don't have any money, so inherently you run out of money because we're spending it all. All right, so let's go down. I want to show you guys something here. What I'm going to do is I have this investment account in our IRA. All right, and we're going to include this in the plan, and and this is a 401k. All right. So now Katie has $500,000 in her 401k, and we're just going to take. Let's do this. Let's have her coming. We'll have a goal instead of 76,000. Let's have a goal of 96,000 a year. There'll be a basically 4% distribution from her IRA. All right, 4% distribution from her IRA, and we'll increase it with inflation. All right, so let's see what our taxes look like here. All right, so I don't know. It'll be interesting. Maybe not much. Not much. Let's get her back into California, actually. Not very many of y'all live in Nebraska, so we'll get you back in California. Come here, Finny. You're all hyper. Chloe just took him for a walk, and he is hyper. He says, Pablo, play with me. All right, so let's go to retirement. What's her likelihood of success? And it's 84% now. Why is that? Well, if we go to cash flow, you can see that her she's taking $20,000 a year from her Social Security, from her retirement account to offset. She only has $76,000 for Social Security, and she needs $96,000 to spend. So she's pulling $20,000 a year from her portfolio. The interesting thing is, remember when we didn't have her taking that money out for because of Social Security, we had a standard deduction. Remember I showed you the standard deduction was, in this case, is $27,000. All right, and so her standard deduction, if you take this minus this, gave her $23,800 of wasted standard deduction. Well, if you look at Social Security, she took $20,894 out of her IRA, And you would think that'd be tax-free, but you'd be wrong. This is the tax torpedo where they say, look, once you're in a certain threshold of Social Security and you make a little bit of money from your IRA distributions, not only does it make more of your Social Security subject to taxation, it makes your IRA distribution subject to taxation as well. So let me show you by 1040 here. I know this is a lot to chomp on, but I want to show you because it's interesting. So here we have $76,000 of Social Security. Let's go to 2022 actually. So we have 81,000 of Social Security, plus we took 17,000 out of our IRA. All right, so in this case, we had 18,000 of our Social Security was subject to taxation, whereas before it was only 3,000. Remember that? So now we have taxable income of $35,000, where before it was only 3,000. You see where I'm going with this? So basically, by taking a $20,000 distribution of our IRA, we've increased our taxable income not by $20,000, but by $35,000. That's a tax torpedo. I'm telling you. So you can't just take a distribution of $20,000 and have no taxes. It doesn't work like that, because it essentially says now where you had no taxable Social Security, now you're going to have taxable Social Security on top of the taxable distribution from your IRA. A nice little freaking setup in the government in 1983 that the Democrats passed, that Reagan signed, to get your taxes of Social Security like that. It's freaking, because they didn't inflate it. The whole thing ticks me off. But they're looking out for you. They're middle class Joe. Remember, Biden was in the Senate back then. Scum. Anyway, so in this case, our Social Security benefit is $18,000 was taxable, only $3,000 was taxable before, plus our distribution from our IRA, which means we have taxable income of $6,998, which means we pay income tax of $700. They're not huge, but it's still, we had nothing before. We took $20,000 out, and yet we have a taxable income with taxes to pay of $700, where before we had nothing. Isn't that crazy? Nuts, man. And then we got $779 to the state of California too, right there, or $79 to the state of California. So I tell you, the whole thing is nuts. Again, I just want to be clear. Well, let me just show it to you real quick. We're going to go back and let me pause. All I did is I did not include Katie's 401k in the plan. And I went back and I changed the amount of income they need from 96 to 76,000 bucks. All right, so if we go back to retirement, we're going to see that we have no taxes at all, right? None whatsoever. Why? Because there is no taxable income. Because when Social Security is your only income, there's no taxes. And if we go to the 1040, let's go to 2022. We'll see. We get 81,000 of Social Security, of which only 4,400 is subject to taxation. That 4,400 is dwarfed by our standard deduction. So we have essentially in this case $24,000 of wasted standard deduction. All right, so now what we're going to do is we're going to go back to profile. We're going to add Katie's 401k back into the plan, and we're only going to take 20,000 from the portfolio as retirement income, because we need 96,000, of which 76,000 essentially comes from Social Security. So we're going to take 20,000, which would say we're still under the standard deduction. Thus, it should still be tax-free. Ooh, but you simpleton, not knowing the tax code. No, it's not. And the reason for that is, now we get $20,000 distribution, which makes, not only is this now subject to tax, but now this 18,000 of our Social Security is subject to taxation. So that $20,000 distribution, we've increased our taxable income by $34,000. That's the tax torpedo. Is that big of a deal? No, not so much. I mean, but it's just kind of funny because, I mean, if you look now, we have taxes where before we did not. Now we have taxes before we did not. Isn't that crazy? But anyways, taxes aren't bad. I mean, $500,000, is that anything to, I mean, look at that. I'm sorry. It's not that big of a deal. You have $500,000, you maximize your Social Security. I'd do that in 2 seconds flat, man. So my whole thing is what I want. Let me show you what I'm trying to do. All right, so what I want to do is I want this to be in a taxable account. That's what I'm trying to do. So if it's in a taxable account, and we'll just make a cost base, and let's just do our cost basis 0. We'll say 0 cost basis, and let's see what this looks like. Now, I bet it won't be taxed. Well, let's see here. We're going to go to 1040, 2022. I have 26,000 distribution from my retirement account. No, I have, yeah, look at that, $263 of taxes. There we go. So we have taxable interest, because at $500,000, I'm giving myself a, what's that, 2 something like that percent, 3% yield. I can't remember, but something like that. And then I'm getting a dividends of I think 2.5% or something like that. Anyway, so then I have a little bit of taxable interest, a little bit of qualified dividends, and that does make some of my Social Security subject to taxation. So before I had $81,000 of Social Security, whereas only 44 is subject to taxation. Now 26,000 is subject to taxation, right? So I have 53,000 of total income, but that's very misleading. Why is that misleading? Because we got to look at the schedules. This is Schedule D, I think, for capital gain. Yeah, Schedule D. And one of the reasons is because it's a capital gain. Long-term capital gain, if I'm still in the 12% tax bracket, is tax flipping free. Big fat goose egg. Qualified dividends, if I'm still in the 12% tax bracket, tax flipping free. The only thing taxes on here, the only thing subject to income, oops, I should come back here. Let's go to cash flows. Oh boy, Finney. Oh, you see something? I love you dogs. The only thing subject to taxation is going to be your federal and a little bit of tax, $384. Why? Because of that taxable interest. That's it. Because taxable interest is ordinary income. So if you're really concerned about your taxes in retirement, and you're really concerned that they're going to go up, and you're like me, 50 years old, man, start paying those taxes now. That way you have more tax-free in the future. I mean, my goal is to live nothing on Social Security and my brokerage account. That's it. That's it. Now, let's say I make this portfolio a little bit more. I mean, that's with a 0% zero cost basis. Let's make it $300,000 cost basis. So now my capital gain is being less. Let's see what this looks like. Go to tax, because I only have for every $10,000 I sell, 6,000 of that is return of principal, if that makes sense. So let's go to 1040, 2022. I know there's a lot to talk about here, but no taxes. Look at that. So I got, because that's all long-term capital gain. I have 60% is return of principal, 40% is long-term capital gain, not subject to any taxation at all. Ordinary qualified dividend is not subject to taxation. The only thing I have taxable is this right here, taxable interest. But you know something? Because taxable interest plus my Social Security is lower than my standard deduction, I got no taxes whatsoever. It's crazy. Crazy. I mean, look at this, man. Come here. All right, I'm going to have to feed these dogs and let you guys go. Look at this. Hold on, big boy. Hold on. Look at that. Tax. And that's just the state of California, by the way. Right there. Nothing to the feds. A little bit of the state of California. All right. Dogs are getting antsy. Love to hear your thoughts. We'll see you.